Okay, let's unpack this.
Mm-hmm.
We are diving deep into the specialty insurance world today, and specifically, we're looking at the Q3 2025 earnings calls of three real power players in the excess and surplus market, the E&S space.
That's right. We've got Bowhead Specialty Holdings, Inc., Markel Group, Inc., and Skyward Specialty Insurance Group.
And this isn't just a standard review of quarterly figures.
No, not at all.
Yeah.
Our mission here is really to give you a high-level strategic analysis. Think of it as your shortcut to understanding where the E&S market stood in late 2025.
And more than that, how three companies all dealing with these shared challenges like social inflation are pursuing, well, drastically different roadmaps to success.
And the contrasts couldn't be sharper.
They really couldn't. On one side, you have Bowhead. They're the relative newcomer, built from the ground up for technology-driven scale and efficiency.
Then you have Markel. The conservative giant. They're all about capital discipline, and right now they're navigating this major internal structural simplification.
Right. And finally, there's Skyward, who's playing a totally different game. They're the specialized niche player, really trying to insulate itself from all that P&C volatility by focusing on these very specific cycle-resistant businesses.
Things like agriculture and captives.
Exactly.
And, these varying approaches, they let us frame this whole deep dive around a core tension, which is how do the tech insurgent, the conservative giant, and the specialized niche player all manage the same enemy?
Which is that persistent casualty severity inflation.
That's it. Every single data point we're going to talk about, from expense ratios to their capital plans, it all reflects their answer to that one question.
So let's jump right in. Let's start with the financial scorecards, the ultimate measure of performance, profitability. We're talking combined ratio and shareholder returns.
Yeah, let's do it. We always assess profitability by looking at underwriting discipline first, and then the bottom line earnings. Let's start with Bowhead Specialty, or BOW. They're showing some really strong momentum from their operational model.
Absolutely. They reported diluted adjusted earnings per share that increased, a significant 23.7%. It came in at 47 cents per share for the quarter.
That's just rapid growth translating directly to the bottom line.
It is.
And their adjusted net income just reinforces that story. It grew 25.5% year over year, reaching $15.8 million.
And if you look at that growth relative to their shareholder base.
Well, their adjusted return on average equity, the ROAE, it stood at 15.1% for the quarter. For a high-growth specialty carrier that's still scaling up, that is a highly efficient use of capital.
And the crucial underwriting number for Bowhead was a combined ratio of 95.4%. That's a very healthy number. It confirms they're making 4.6 cents of profit on every premium dollar before you even factor in investment income. It really shows they are successfully managing the risk of that growth strategy.
Okay, so now let's pivot to Markel Group, which is, it's a fundamentally different beast because of its diversified conglomerate structure.
Right.
When we look at their insurance operations specifically, they reported adjusted operating income of $621 million. That's a robust 24% increase year over year.
And the insurance segment was truly the engine room for that. It contributed $428 million to that adjusted operating income, which is up substantially from $276 million in the prior year period.
It is.
That really demonstrates that their core insurance business is performing exceedingly well, especially after all their strategic shifts.
But here's the nuance you have to understand when you're looking at a company like Markel. Their overall comprehensive income to shareholders for the quarter was $793 million.
Okay.
However, their total corporate operating income for the quarter was $1 billion, which was actually down from $1.4 billion in the prior year.
That variance, that $400 million drop in total operating income, that's crucial to contextualize.
It's everything. It is entirely driven by their massive investment portfolio. Markel realized net investment gains of $433 million this quarter, compared to a much larger $918 million in the same period last year. So it just highlights the volatility you get when you have a huge diversified balance sheet. When investment markets slow down, even stellar insurance performance can get overshadowed by lower realized gains.
But despite that investment noise, the core underwriting story for Markel is one of dramatic improvement.
It really is.
Their Markel insurance segment combined ratio improved significantly to 93% for the quarter. That's compared to 97% last year, a 4-point jump in efficiency in a single year. That's a major strategic win.
It speaks directly to the effectiveness of their portfolio pruning, getting rid of those unprofitable lines, which we'll get into later.
Right.
And management, they really emphasize their long-term stability. They noted the 5-year average after-tax return on equity for the Markel insurance segment, so covering 2020 through 2024, was 12%.
It confirms that commitment to just compounding shareholder capital through thick and thin.
Yeah, it does.
All right, finally, let's turn to Skyward Specialty, SKWD, which, I mean, they posted figures that are just rewriting the record books for them.
Yeah, they really did. They delivered $44 million in operating income, which their management proudly stated was a new company record for the third quarter.
And their net income hit $45.9 million. That's what, $1.10 per diluted share, all driven by underwriting income of $38 million.
And the headline numbers just keep going up.
They do. Skyward delivered an annualized return on equity, or ROE, of 19.7%. That is nearing 20%, which is an exceptionally high figure for this sector.
But the number that truly captures their strategic success in Q3 is their combined ratio.
A company best 89.2%.
Exactly. That means Skyward is generating nearly 11 cents of underwriting profit for every single premium dollar.
So if we pull back and we just look at the spread in those Q3 combined ratios, you have Skyward at 89.2%, Markel in the middle at 93%, and Bowhead at 95.4%. That is nearly a 6-point efficiency gap between the highest and the lowest.
And that gap tells you everything you need to know about their risk appetite and their portfolio structure. Skyward achieves that 89.2% through a heavy focus on shorter tail, niche businesses.
Agriculture, surety, A&H.
Right. Lines where losses emerge quickly and are, frankly, easier to price accurately. Bowhead, on the other hand, is consciously pushing its combined ratio higher, around that 95% mark, because they're aggressively leaning into that longer tail excess casualty business.
Which requires higher loss ratio assumptions up front.
It does, but it promises greater long-term compounding. So it's not just a measure of immediate efficiency. It's a strategic choice about liability duration and risk tolerance.
And Markel, sitting there in the middle at 93%, is just benefiting from years of conservative reserving and that recent portfolio discipline, but they're still carrying the drag of exiting those legacy reinsurance lines.
That combined ratio spread is the perfect segue into our next topic.
Premium volume. If profitability defines how well they are underwriting,
then premium growth defines where they're finding the opportunity.
Exactly. Okay, so we're moving from efficiency to volume. We're focusing on gross written premiums, or GWP, and specifically which lines are fueling the growth engine for, our three archetypes: the tech insurgent, the conservative giant, and the specialized niche player.
Let's start with Bowhead Specialty. Their model demands scale to make their technology investment pay off.
And they're getting it. Their GWP increased a very healthy 17.5% year over year, reaching approximately $232 million for the quarter.
And that growth is laser-focused. Their casualty division drove the overwhelming majority of that. It grew 20% to $145 million. And management was very clear. This was primarily fueled by excess casualty business.
This is where Bowhead is placing its biggest bet.
Without a doubt. They see excess casualty as the most favorable segment. You've got compounded rate increases, stronger terms and conditions. It's really the sweet spot where they can deploy capacity quickly and efficiently.
Other divisions are growing, but more moderately. Healthcare liability grew 11% to $35 million. That was driven by management liability, hospitals, and senior care portfolios.
The professional liability division, though, was much more subdued. It increased only 2% to $46 million.
And why was that?
Well, while they saw growth in commercial public D&O and cyber, that was partially offset by decline in their financial institutions' portfolio premiums. And this is the first real signal that the E&S market is starting to soften in specific competitive pockets.
In this case, financial institutions D&O.
Exactly. But here is the key signal of Bowhead's strategy really working. Their proprietary technology platform, Baleen.
Right.
It generated $6.2 million in premium during the quarter. That's an astonishing 83% growth just from Q2.
83%, quarter over quarter.
And it exceeded the total premium written by Baleen in the entire first half of 2025. This acceleration is crucial. It's not just a number, it's the manifestation of their strategy.
Baleen is their pathway to scale without linear growth in headcount or expense.
That's it. It shows the technology is finally hitting critical mass, allowing them to underwrite small, high-volume, virtually no-touch business that the rest of the market either ignores or just prices inefficiently.
Okay, so transitioning to Markel Group. Their overall underwriting GWP was up 11% year-over-year for the quarter, but the year-to-date growth was a more restrained 4%.
Yeah, and that suggests there's structural changes and the pruning efforts from earlier in the year were still having a kind of normalizing effect on their overall volume.
And Markel's growth is coming from several more diversified areas.
It is. They saw strong growth in personal lines, general liability, and their international lines, which showed a phenomenal GWP growth of 25%. So that diversification across geographies helps offset any domestic volatility.
Their Programs and Solutions division also showed solid expansion, growing GWP by 12%. But we have to talk about the strategic exits. Their Wholesale and Specialty division GWP was down 6% overall.
And management was very clear about the context there. That 6% decline included a 5% impact from their strategic exit of the U.S. risk-managed professional liability lines.
So if you back that out,
When you exclude that deliberate pruning, the Wholesale and Specialty division was only down 1%. This just confirms that Markel is strictly prioritizing profitability over volume. They are willing to sacrifice top-line growth if a line of business is not meeting their hurdle rates for compounding capital.
now for the sharpest contrast, let's look at Skyward Specialty. They reported GWP growth of a staggering 52% in the quarter.
Which management rightly called unusually robust and a new company record.
52% growth is massive in any market. Where did it come from?
We know exactly where. The agricultural unit was the single largest contributor. They specialize in U.S. dairy and livestock revenue protection, and it's a highly specialized niche market that Skyward just dominates.
But the crucial questions are sustainability and concentration risk, right?
And management preempted that question. They stress that even if you exclude the agricultural unit, their aggregated GWP growth was still extremely robust at a mid-teens rate.
So ag provided the spike, but the underlying portfolio is still expanding rapidly.
Exactly. They saw 5 of their 9 divisions growing by over 25%. That includes A&H, up 45%, captives, surety.
Surety's rebounding, right, by 20%.
It is, because those federal funds are finally flowing into infrastructure projects. But we have to heed management's caution. They noted that quarterly growth is expected to be uneven.
Because of the renewal cycles.
Precisely. Niche divisions like ag, A&H, captives, they all have highly concentrated renewal cycles. So you might see a huge spike one quarter and then normalization the next. It adds a layer of complexity for investors who demand that smooth, linear growth.
So that concentration risk is the key synthesis point here. You've got Bowhead growing fast, but diversifying internally with tech. Markel is growing selectively, balancing exits with high-quality international growth. And Skyward is growing explosively, but relying on the cyclical timing of these massive niche contracts.
It shows 3 totally distinct ways to attack the E&S top line.
So now that we understand where the money is being made and where it's coming from, we have to dissect that combined ratio even further.
Yep. We need to focus on the components. Loss control and operational efficiency. And this will bring us straight into the core difference between that 89.2% and the 95.4% combined ratio we talked about.
Right. This section, underwriting quality, it's all about dissecting whether these companies are winning by controlling claims, the loss ratio, or by being hyper-efficient administrators, the expense ratio.
And we really need to pay close attention to Markel's 36% expense ratio compared to the sub-30s goals of the other two. Let's start with Bowhead, the tech insurgent, which is unequivocally winning on the operational efficiency front.
They achieved a highly efficient expense ratio of 29.5%.
And that's an improvement of 40 basis points year over year. Management attributes this directly to technology, scale, and prudent expense management. They are committed to their sub-30s target, and they are hitting it.
But their current accident year loss ratio, it trended slightly higher. It increased 30 basis points to 64.8%. This is critical to analyze. Why is their loss ratio going up if they're so disciplined?
And management was transparent about this. They said it was solely due to the product mix shifting toward casualty products, which inherently carry higher initial loss ratio assumptions.
So they're choosing longer tail, higher risk lines.
But ultimately more profitable lines, which pushes the current year loss ratio up, but they believe the overall risk profile remains strong because of the pricing they're getting.
And they also gave some necessary context on their prior accident year development. They confirmed that any change in the prior year loss ratio was simply IBNR, incurred but not reported.
Right, booked on audit premiums related to prior policies. Management made it a point to say this was not based on actual losses settling for more than they'd reserved.
And that differentiation is vital for any listener. They aren't suffering from adverse development like some of their competitors. They're just cleaning up administrative premium adjustments.
Exactly.
Yeah.
However, we have to address their high reliance on industry data. Given Bowhead's relatively shorter history in these long-tail lines, IBNR accounts for 88.2% of their total reserves.
88% is huge. For a listener tracking the stability of a new, growing insurer, what risk does a high IBNR percentage imply, especially in long-tail casualty?
It implies that their reserving strength relies heavily on industry-observed loss trends rather than their own extensive internal history of settled claims. I mean, their management team has decades of experience, but the corporate balance sheet is newer.
So they have less internal data from settled claims.
Right. It requires more assumption about how reserves will develop. It's a necessary trade-off for a high-growth company, but it's a data point we have to watch very closely. A big contrast to established giants who rely much more on case reserves based on hard claims data.
And that sets the stage perfectly for Markel Group. They showed that a dramatic 4-point combined ratio improvement from 97% down to 93%.
And management specified that 3 points of that improvement came directly from lower cat activity, and 1 point came from lower losses from something called CPI custom policy indices.
So roughly 3/4 of that quarterly jump was just related to a benign weather period.
It was. However, their core reserving strength remains consistent. Their favorable prior year loss development, or PYD, it stayed at 6 points favorable in both the quarter and year-to-date periods.
6 points of favorable PYD speaks volumes. For anyone unfamiliar, prior year development is when an insurer realizes the money they set aside for claims in prior years was actually more than they needed, so they can release that surplus back into income.
And consistent favorable PYD shows that Markel's historic reserving philosophy is consistently conservative. They did mention some offsetting factors. There was some adverse development recognized in the first half of the year in reinsurance casualty lines and those discontinued risk-managed professional liability lines.
So that's the structural cleanup we talked about earlier.
It is. The tail of the business they exited is still generating some losses, but the consistent favorable development elsewhere is more than sufficient to absorb that.
But here is the major strategic puzzle piece. Markel's expense ratio stood at 36%. That looks like a typo next to Bowhead's 29.5%.
It's not a typo. It's a strategic reality. Management acknowledged it's relatively high versus specialty peers, but stressed their focus is on the overall combined ratio. The 36% is the cost of doing business their way.
And they even noted that the planned exit of the lower expense global reinsurance division, which had an expense ratio around 28%, is actually going to cause a slight drag on the overall reported expense ratio.
It will, as that premium burns off.
So if Markel is running a 36% expense ratio, what's the trade-off? What is the cost they're paying, and what benefit do they believe they're buying?
Well, the cost is competitiveness against new entrants like Bowhead, who are built digitally from the ground up. The benefit, Markel would argue, is underwriting talent and local specialization.
So a more decentralized model.
Exactly. It values individual underwriting expertise, which requires more infrastructure and higher employee costs than a centralized no-touch platform like Baleen. They're buying resilience, market access in high-cost regions like international, and the ability to underwrite highly complex, bespoke risks that pure automation just can't handle yet.
Okay. Finally, let's look at Skyward Specialty, which is demonstrating hyper-efficiency. Their expense ratio was 28.4%.
An impressive 4.5-point improvement year over year, landing them firmly in their target zone of sub-30s.
And that efficiency gain is remarkable.
It is, and it's primarily due to economies of scale on their rapidly growing premium base. Their non-cat loss ratio also improved by 0.4 points, landing at 60.2%. Their overall underwriting is just extremely clean.
Skyward's reserve picture is also interesting. IBNR makes up 73% of net reserves, which is lower than Bowhead's 88%, and their liability duration continues to shorten.
And that shortening liability duration is a critical advantage right now. It means less exposure to future adverse social inflation trends because they are rapidly realizing their claims. It aligns perfectly with their focus on shorter tail lines like agriculture and surety.
And management confirmed a ground-up review of their loss reserves is coming in the fourth quarter.
Right, which is part of their standard process. It just demonstrates their conservative reserve philosophy, especially given the ongoing industry concerns about auto liability trends.
So that comparative analysis of expense ratios, Bowhead at 29.5%, Skyward at 28.4% versus Markel at 36%, it really shows the clear strategic divide.
It does. Bowhead and Skyward are basically racing each other on efficiency, believing technological leverage is the future.
While Markel is accepting a higher overhead cost, betting that their structural reorganization and their decentralized, high-touch approach will yield superior long-term profits regardless of the administrative costs.
That's exactly right. That 36% ratio is the price Markel is willing to pay for stability and control.
Now that we've thoroughly dissected the income statement, let's pivot to the balance sheet. Let's examine reinsurance and capital strategy. How are these three companies funding their expansion, mitigating their exposure, and managing the capital they generate?
Capital strategy is the foundation. It's what these high-growth specialty players build their future on. It dictates not only their risk tolerance, but how quickly and aggressively they can deploy capacity into favorable markets.
Bowhead, being the younger, rapidly scaling entity, is focused on building organic capacity. Their total equity reached $431 million, driving their diluted book value per share to $12.75.
Which is a very healthy 16% increase from year-end. And they're also optimizing their liquidity. Net investment income increased 31% year-over-year to $15 million, driven by a higher asset balance and improved yields.
Their book yield was 4.8%, and the new money rate was 4.6%, so they're efficiently capturing those higher interest rates.
Right. But the big news was their capital plan. Management stated they are planning to access capital through resources other than the equity markets by year-end.
Which is a very specific signal.
It is. It suggests they are growing faster than they anticipated at the time of their IPO, which is a good problem to have, but it creates a capital strain.
So they're opting for debt.
It seems so. They have available debt capacity and are choosing that route to avoid diluting existing shareholders. They expect their net premium to surplus ratio will remain safely under 1 for the next couple of years.
They also noted a critical point about risk transfer. Reinsurance options were limited for meeting their current year's RBC or risk-based capital requirement.
Which just reinforces that in the current market, high-growth carriers are finding traditional reinsurance harder to access for capital relief.
Now, Markel Group is at the complete opposite end of the spectrum.
They are. Their capital allocation is defined by this massive, consistent commitment to returning value to shareholders.
How massive?
Since the end of 2020 through Q3 2025, they have returned a phenomenal $1.9 billion to shareholders via share repurchases.
Wow.
It reduced the share count from 13.8 million to 12.6 million. That's an incredible demonstration of capital discipline.
It confirms that the underlying cash flow from their whole diversified structure, insurance, industrial, financial, and consumer, is sufficient to fund growth, absorb legacy costs, and continuously reward shareholders.
And their investment strategy reinforces that capital preservation mandate. 96% of their fixed income portfolio is rated AA or better.
They prioritize safety over yield chasing.
Definitely. Their book yield is a bit lower at 3.5%, reflecting older assets, but their current reinvestment yield is 4.2%, showing gradual improvement.
Okay, now let's turn to Skyward, where the capital management is highly dynamic. Their net retention increased to 65.1%, up from 62.9%.
And that increase in retention is influenced by their strategic mix. Management pointed out that divisions like agriculture use very little reinsurance, which pushes the net retention higher overall, even though lines like global property and A&H use sizable quota share support.
So they're keeping more of the good short-tail risk.
That's the idea. And Skyward also executed a very deliberate investment strategy shift. They completed the monetization of their equity portfolio, realizing gains of $16.3 million.
And then aggressively redeploy the proceeds into fixed income.
Yep. That's a strong signal. Monetizing equity and shifting to fixed income implies they're moving aggressively toward income predictability.
Maybe anticipating market volatility or just aligning with the low volatility nature of insurance liabilities.
Could be both. They deployed that capital at a high Q3 yield of 5.6%, which resulted in an enhanced embedded yield of 5.3% across the whole portfolio.
And their acquisition strategy, culminating in the Apollo deal expected in early 2026, reveals their M&A capital philosophy.
It does. Their debt-to-capital ratio is expected to jump from below 11% to approximately 28% after the deal closes. And management said they are not uncomfortable with 28% leverage.
The genius of the Apollo deal is the model itself, right?
Absolutely. Management specifically highlighted Apollo's capital-light economic model, where 75% is funded by other people's capital. This shows Skyward's ability to execute significant profitable growth without fully straining their own balance sheet.
It hints at a future where more of their business could be fee-based and capital light.
So you have three radically different approaches to capital deployment. Bowhead needing debt to fund surging organic growth, Markel continuously returning capital through massive buybacks, and Skyward executing capital-light M&A while actively enhancing investment predictability.
It's a fascinating look at how growth is financed in the modern E&S market.
It is.
And that context is crucial because it influences their appetite for risk in the external marketplace. So let's pivot now to market and pricing dynamics. Where exactly do these three companies see the opportunities, and where are they detecting the highest risk?
This section reveals how those core strategies we just discussed, tech efficiency, structural stability, and niche specialization, translate into actual market choices. And the common theme is the high degree of selectivity required because of that casualty severity inflation and increasing property competition.
Bowhead characterized the market as still highly favorable. They're benefiting from compounded rate increases, stronger terms and conditions, and lower average limit deployment since 2020.
They're maximizing the structural advantages created by the previous hard market cycle. And they are convinced that casualty is the most favorable segment, particularly excess casualty.
Which explains why it's the primary fuel for their 20% growth in that division. They're going where the margin is best protected.
And they noted that E&S casualty premiums continue to grow, which contrasts sharply with the overall 1% decline in E&S premiums across California, Florida, and Texas.
Which management said was driven by a decline in E&S property premiums?
Exactly. It underscores the migration of risk. Casualty is hardening, property is softening slightly, but their discipline really shines through on the professional liability side.
Right. Pricing for D&O and cyber was described as pretty much flat, maybe a little bit up.
And highly competitive, especially in financial institutions. D&O due to what they call an overabundance of competitors. So Bowhead is prepared to pull back from lines where excess capacity erodes their margins.
And their strategy is also defined by what they actively avoid. They deliberately steer clear of primary commercial auto and Fortune 1000 business.
They believe those classes were historically underpriced and are the source of legacy adverse development for so many others. They're just playing the game of avoiding systemic losers.
Markel's perspective on casualty seems to confirm Bowhead's caution.
It does. They described casualty as a difficult class to get the price right and confirmed they are not putting our foot to the floor, even with attractive ratings in some areas. They remain highly selective in their risk appetite.
And on the property front,
Markel anticipates challenges. Management believes the overall market will put pressure on rates because of a quiet domestic storm season. But they stress that Markel is not CA dependent, meaning they have the strategic flexibility to remain disciplined even if competitors chase volume in a softening property market.
they give a great overview of the wholesale market. Property is shifting back and forth between E&S and retail, but importantly, casualty is flowing into the E&S market, which is experiencing a hard market.
Right. And they expect the wholesale market to remain massive, estimating it at over 25% of the U.S. commercial line space.
Okay, now let's look at Skyward Specialty, which maintains extreme vigilance on loss trends, especially related to that shared enemy of casualty severity inflation.
They highlighted persistent auto liability severity inflation and auto-exposed excess severity inflation, noting this particularly impacts their construction unit. This is exactly why their portfolio shift to shorten liability duration is so strategic.
So they're maintaining a highly selective position on growing exposure in occurrence liability lines.
If they can't get the price right to hedge against future inflation, they simply won't write the business, regardless of volume targets.
And where they see heightened competition is in global property, E&S property, and inland marine,
All of which are becoming increasingly competitive. This just reinforces the shift that Bowhead noted property is clearly softening.
But despite that pressure, Skyward's overall renewal pricing increased to mid-single digits plus pure rate, excluding global property.
Which indicates their focus on specialization is paying off. In their niche areas, they still have pricing power.
And their captives business provides a valuable economic hedge.
Growth is stable there because captive members are insulated from the P&C cycle. They are essentially underwriting their own risk, ensuring that pricing is kept up against loss trend because, as they say, they're eating their own cooking.
And Skyward is actively innovating. They launched InWell, an amortized collateralized surety product for oil and gas decommissioning.
A perfect anecdote. It addresses a challenge in the surety market resulting from high-profile bankruptcy-driven losses. They identified a niche problem and built a bespoke solution, further insulating their book.
So this section confirms it. Casualty inflation remains the central underwriting challenge. Bowhead avoids the worst risks, Markel remains cautiously selective, and Skyward fights back by reducing exposure and using specialized products to maintain pricing power.
Exactly. The sophistication of their market analysis shows that these quarterly results are not simply luck. They are the result of highly deliberate choices about capacity deployment and risk selection.
We've covered the financials, the structure, and the market view. Now, let's wrap up with the strategic differentiation and future plans. This is where the long-term success of the tech insurgent, the conservative giant, and the specialized niche player will truly be decided.
This final section is perhaps the most important because it outlines the management team's commitments. They all have ambitious goals, but their pathways diverge sharply.
For Bowhead Specialty, the focus remains squarely on tech-driven scale. Management emphasizes disciplined underwriting and operational excellence.
Viewing technology not just as an administrative tool, but as a foundational element for enhancing decision-making and improving risk selection. Their platform, Baleen, is their primary weapon.
It currently drives their small cyber growth up to $50 million in revenue with virtually no-touch underwriting, which fuels that excellent 29.5% expense ratio.
And the key future move is extending this technology to small casualty business, which they've dubbed Express.
The Express platform is designed to handle hundreds of submissions too small for their current underwriting appetite,
which allows them to capture highly profitable, high-volume small business that others can't process efficiently. This is their strategy to multiply underwriting capacity without proportionally multiplying headcount.
They explicitly stated that future growth will be highly leveraged. The growth per headcount ad will be a lot more going forward than in the past.
Which means, as their technology accelerates, their operational efficiency should continue to improve, putting massive competitive pressure on peers who rely on traditional underwriting staff.
Okay, now let's turn to Markel Group. The strategy there, led by CEO Tom Gaynor, is all about simplification and accountability.
Gaynor stressed the commitment to relentlessly compounding capital and continuing to do more of what works and less of what does not. It's a mantra of deliberate, cautious growth.
And the structural changes they implemented are far more dramatic than a simple internal reorg.
They are. They collapsed the complicated matrix reporting structure in the U.S. and reorganized into 4 simple, distinct divisions.
And this was a strategic decision to enforce accountability. They pushed over 80% of central functions people into the newly created P&Ls, ensuring business leaders have full transparency over costs and full responsibility for their divisional results.
This directly addresses that 36% expense ratio we talked about. By pushing those central staff costs directly onto the divisional P&Ls, Markel is creating internal pressure on business unit leaders to manage costs aggressively.
So it's an attempt to turn a historical weakness into a future strength.
That's the hope. Management is confident the changes have set a stronger foundation. With leaders stating they are back, they're shifting focus toward leading indicators, submission count, quote, rate, employee engagement, knowing that in long-tail lines, the true financial benefits of structural change take time to materialize.
And regarding capital, they remain committed to stock buybacks. They're projecting the next 10% reduction in share count might happen in just 3 to 5 years.
A very clear capital return target for investors.
Finally, Skyward Specialty is focused on niche insulation and the integration of Apollo.
Right. Their core strategic differentiation is product mix. Nearly 50% of their business mix through the first 9 months is less exposed to the P&C cycles.
Specifically ag, A&H, and captives. That insulation is their hedge against the volatility we see in the wider property or general liability markets.
And they're also investing heavily in technology similar to Bowhead, but perhaps focused more on risk assessment than pure automation. They're utilizing their Skyview underwriting workstation and bots GPTs for AI-driven risk assessment.
Automating submission ingestion and generating summarized risk narratives.
Yeah, they believe this gives them a first-mover and learning curve advantage in using generative AI for underwriting insights.
And the Apollo acquisition remains a high priority, expected to close early in Q1 2026.
It does. And here's the strategic takeaway from that deal. Management explicitly highlighted Apollo's capital-light economic model, 75%, funded by other people's capital.
Right.
This demonstrates their ability to diversify their profit stream.
Moving toward a fee-based model where they use their underwriting expertise but deploy less of their own balance sheet capital.
Which offers massive growth potential with lower regulatory and reserve strain.
So, to synthesize this entire deep dive, all three companies posted strong Q3 2025 results, validating the strength of the E&S sector. But the strategies are fundamentally divergent. Bowhead is an efficiency story driven by tech scale and casualty.
Markel's undergoing a structural turnaround focused on accountability and maximizing shareholder capital returns.
And Skyward is a specialized portfolio story, using niche insulation and capital-light M&A to outgrow and avoid market volatility.
The key nugget of knowledge for you, the learner, is understanding which of these strategic advantages will hold up best when the E&S cycle inevitably begins to soften.
Right. Bowhead is leveraging technology, Markel is leveraging structural changes for accountability, and Skyward is leveraging unique product niches and M&A.
And it's clear that while the casualty market remains attractive, the competition in D&O and E&S property is increasing, forcing discipline across the board.
Which leaves us with a provocative thought to consider.
Given the increasing competitive pressure in E&S property and the persistent, costly severity inflation in auto liability, the market is becoming highly nuanced. Which of these three distinct strategies, Bowhead's tech efficiency aiming for sub-30s expense ratios, Markel's structural simplification aiming for accountability, or Skyward's niche insulation and capital-light growth, is best positioned to navigate the transition into a softening or mixed P&C market over the next 3 to 5 years? That choice determines their long-term value.